yesterday or the day before? No, right after pool class on Tuesday. Ooh, okay. Thank you. Should I email you again? Or? Okay. Thank you.
Okay, folks. So this stage, no point nagging. You know what's coming. So it's 5 days from now, 4 days from now. Monday your project's due, so everything's going to hit the blank. So, whatever you need to do, start getting to the end game. If you get a chance also, when you have the numbers for your company, if you can send me your numbers in that summary spreadsheet. All I ask you for is what's your DCF value, what's your pricing, what's the price today, buying or selling. So 5 numbers or 4 numbers. I also ask you what model did you use, what multiple did you use. And what I do is I collect those numbers you will send me, and today we're going to be done with packet 3s, right? So there are no more slides left. But there will be a closing presentation I send you for Monday built around what you send me. It will be a review of the class using what you found. What discounted cash flow model is, how many of you found your companies to be under or overvalued. But to do that, I need your numbers. And if you think about the logistics of this, here's what I need to do. I need to get your numbers. I need to put them in a big spreadsheet. I need to get the summary and I put them in slides and get the slides to you, which also means that I need some time. Like you can't send it to me 20 minutes before class and expect that to end. So I'll put the latest I can start, I can incorporate things is probably midnight on Sunday, but that's about as late as I can push it. I mean, I'd obviously prefer to get it earlier, and if you can get it to me Friday, Saturday, that's so. When you have the numbers, I'd also prefer to get it as a group if you can, because it's fewer things to cut and paste. It's purely from my perspective, it's easier to do. But if you have 6 people in a group and 1 person or 2 people are holding you up, just send me the numbers for the 4. I'd rather have 4 out of 6 than none at all. So don't hold out for that 5th or 6th person if it looks like they're going to get done at 4:59 p.m. on Monday. You hope. No. So that's the project part. Now, any questions on the project? Formatting, you see from past projects, I have 0 preferences. If you want to do it as a PowerPoint slide, that's fine. If you want to do it as a Word document, that's fine. Either way, convert it to PDF files for a simple reason. PDF files travel much better across operating systems. Strange things don't happen to it. It's easier for me to grade and put so even if you have PowerPoint slides, just save it as a PDF file so that when I give my comments, I can do it on it. And I will send you more information about that project when you turn it in to me. I will give you specific instructions on the subject you need to put, because it's going to really get hellish on Monday night, because I'm going to get 1,200 people in 3 different classes all sending their projects in. And who knows where your project will get buried if it doesn't go into the right box. So I will send you those instructions as you go along. The way you're going to get the graded project back is I'll just reply to the email that you sent with your project. So make sure you CC everybody, and make sure you don't BCC people you don't want to. Actually, 2 days ago, I talked about BCC. I was on my way to Dartmouth at night. I was going to Dartmouth to give a talk. So I'm late in the evening, I'm in the car working on things, and I want to get things done because I actually took the train to New Haven. A car picked me up in New Haven, was driving to Hanover, which is a long drive. So I said, I'll get some work done. Bad mistake. Because I finished the exam I wrote for my corporate finance class, and it took me about 3 hours to do, and I want to get it checked out. So I decided to send it to the TAs for the class. And by accident, guess who I carbon copied? The entire class. They got quite a shock because they got the entire final exam and the solution, which basically means that on my way back from Hanover, I had to write a fresh exam. So there are far worse things that can happen to you in life. I've been very careful about my CCing since then, but that too shall pass. So today we're going to put, that's the project. The final exam, as you well know, 17th is the official final exam date. 14th is the early version. I think the early version is pretty much filled in terms of number of slots. And so if you put your name down there, great. If you haven't put your name down there, go and check out those last few slots. If you put your name down there and you've changed your mind, take your name out, because you don't want to hold up a slot if you don't need it. But the final exam is 17th. So that's it for the logistics of the rest of the class. Today we're going to wrap up the class. We're going to talk today about changing value. So far, everything we've done in the class, we've looked at value from the outside in. You know what I mean by the outside in? You value a company, you essentially take the company that's run by somebody else, you value the company given how they run it. You can't change it, it's not your company. You value Facebook. What you and I think about how Facebook should be run is irrelevant, it's what Mark Zuckerberg thinks. You value the company as run by Mark Zuckerberg. Today I want to open the door to value, and we're going to go on the inside. As many of you know, I teach two classes. I teach a corporate finance class to the first year MBAs, and I teach a valuation class to the second year MBAs. I haven't taught corporate finance to the undergraduates since I think 2007. Right? In fact, I renamed the class corporate finance. I don't know what your corporate finance class was called. Whatever it was not appropriate. I don't think this class should be called, what is it called, equity valuation? I think it should be just called valuation. Notice I've consistently not used the word equity valuation, because it's really nothing to do with equity. Why you value businesses, you value, so it's, But that's neither here nor there. But people often ask me, the MBAs, because they take the first year, and say, what's different about your valuation class? And I say, it's the same thing, I just repackage things. And that's really the truth. The principles don't change, the concepts don't change, but here's the basic difference between the two classes. In valuation, I look at companies from the outside in, as I described. In corporate finance, I look at the same companies from the inside out. I look at it from the perspective of somebody managing, running the company. And there you have more degrees of freedom. Do you see why if you don't like the way something is done, you can't bitch and moan to me about it. You run the damn company. Do something about it. Don't tell me, the projects are terrible projects. Who took these terrible projects? You did. So this is going to be a much more active part in valuation, where you look at companies and say, what can I do to change the value of a company? So to set up this process, let's do what start of the class does. I'm going to list out a series of actions, and I'd like you to tell me whether these actions can change the value of a company. A stock split. What does a stock split do? It just changes the number of units in the company, and having a stock split cannot make a bad company into a good company or a good company into a bad company. A reverse stock split, same thing. So MoviePass can do as many reverse stock splits as they want, but they would stay an abysmally bad company. Nothing can change. A stock split is a completely neutral event. It doesn't change value. So what's the test we do to say does it change value? What are the questions you're asking? Does it affect the cash flows? Does it affect the growth? Does it affect the risk? If the answer is no to all three, the answer is it doesn't affect value. Stock split doesn't. What about amortizing goodwill or impairing goodwill? What does that do? First, when does goodwill show up on your balance sheet? When you do an acquisition. When do you impair goodwill? When accountants decide you paid too much. When did they decide you paid too much? About 3 years after everybody else in the world realizes you paid too much, they impair goodwill. So to decide whether, so Kraft Heinz, for instance, impaired, I think, $15 billion in goodwill. That's bad, right? So if you're valuing Kraft Heinz right after you hear about the impairment, shouldn't your value go down? What's the test we need to run? Does impairing goodwill affect cash flows, affect growth, affect risk? First, the growth and the risk, let's take out of the picture. This was a mistake you made 3 years ago. I wish you hadn't made it, but it really has no effect on future cash flows and growth. What would have to be true about goodwill impairment or amortization for it to affect cash flows? If it is a tax deductible expense, this is actually good news for you. It's in a very perverse way good news, because a $15 billion tax deduction is going to save you about $4 billion in taxes. Here's the unfortunate reality about goodwill impairment. It is not a tax deductible expense. I've always wondered why accountants waste time impairing goodwill. Nothing is gained from it. No cash flows are affected. But I guess it's make work for accountants day. So this is one more thing that makes work for accountants. Impairing goodwill has no effect on value. What about changing depreciation methods but only in your reporting books? You know, U.S. companies are legally allowed to have two sets of books. You can have your tax books, which is what you show the IRS, or your reporting books, which is what you see in the 10K. And you're allowed legally to maintain two sets of books. Yeah. Yeah, in fact, why would you change depreciation methods? First, which depreciation method are you going to pick in your reporting books that's, you know, depreciate more. So you're going to use accelerated depreciation in your tax books, and in your reporting books you can say, no, we didn't depreciate very much. You're going to use straight line depreciation. Makes you show higher earnings in your reporting books while getting your tax savings. But again, let's look at it from the perspective of valuing this company. You're playing a reporting game, right? Your tax savings are still your tax savings. Your cash flows are still your cash flows. Changing depreciation methods just in your reporting books might fool some of the people a lot of the time. Which people? The people who blindly slap a PE ratio on your net income or earnings per share because they go, oh my God, their earnings went up. Their earnings went up because they changed depreciation methods, but your value hasn't changed. Would it be different if I told you they changed depreciation methods in their tax books? Yeah, then it would affect cash flows. Then we've got to think about what the consequences are. In the 1990s, US companies created this phenomenon called tracking stock. I'll give you an example. Okay? New York Times created a new division in the 90s. It was their online division. They called it NewYorkTimes.com. They created tracking stock on New York Times. What did it entitle to? Absolutely nothing. Okay? Basically, we bought tracking stock in New York Times Online. You got equity with none of the claims that come with equity. You had no corporate governance, no board of directors. You got a share of the earnings on the tracking stock, but New York Times decided what that share of earnings was because they control both pieces. By itself, when you think about what tracking stock does, New York Times plus online was there before they issued the tracking stock after. So all it does is it divides up the value. Again, by itself, it's changing nothing about the company. Cash flows are the same, growth is the same, risk is the same. Nothing changes. Yeah. That's exactly going to be my name. None of these actions change the value of the company. But could they affect the stock price? First, take a stock split. You know that stock splits historically have been associated with an increase in the stock price, the adjusted stock price. Why? You can tell a story about only companies that think they can grow faster in the future are going to split their stock. Therefore, the price went up. But it's a dance around a story. Stock splits do affect the price. They don't affect value. Could changing your, reporting a big goodwill impairment affect it? Yeah, maybe people look at the 50, oh my God, this is a terrible mistake, and they knock down your price. Maybe changing depreciation methods. So each of these actions can affect the price. And one of the things I want to talk about today is most CEOs, when they talk about wanting to enhance value, should really tell you the truth. They're not interested in enhancing value. What do they want to do? They want to increase the price. And when you think about what you need to do to increase your stock price, it might be very different than what you need to do to enhance value. And that's an interesting conflict you face as a CEO. Should I do the right thing for my company in terms of what makes me a more valuable business? Or should I go for whatever cosmetic thing I need to do to push up my price? And 9 times out of 10, which side wins out? You're going to go to the cosmetic price. Now, let me put you deeper into this process. Let's suppose you've just been hired as a CEO. That's a pretty good upgrade, right? You graduated and right away you become a CEO. And you skip all those steps. You just go to the top. Maybe it's a one-person organization, but you're right at the top of that one-person organization. But you manage to get 4 businesses in this company. And I've been very creative. I've called them A, B, C, and D. There are the returns on capital in each business and the costs of capital in each business. You're the CEO. You want to divest one of these businesses, and your end game is you want to increase your value as a company. That's what you want to do. Not price, increase value. So I'm going to ask you a question. The answer is going to look obvious, but I want you to look behind the answer. Which of these 4 businesses would you divest as the CEO of the company? What's the obvious answer? D, right? Why? Terrible business, right? You get rid of, in fact, isn't that what the rule book for turnaround management is? When you come into a company, get rid of the worst businesses. But what determines what happens to your value when you do a divestiture? You give up cash flows, right, when you divest, and you get something back. So what drives whether your value goes up or down on a divestiture? It's what people will pay for this bad business. So let's go around, you trying to shop this bad business. Right? You want to buy this terrible business, how about? And what do you think the prices are going to look like? Everybody knows this is an awful business. Unless you can somehow convince them that this is somehow a great business that was bad only because you ran it. And this is where having, acting, oh, I'm really stupid, I don't know how to run companies, this could be a great business. But the reality is, trying to get rid of your worst business often comes with this divestiture value that might actually be lower than what you... Remember, this is not a money-losing business. It's got really low cash flows. So when you value it, it's going to be much lower than the invested capital. But that value might still be higher than what you get in a divestiture. In fact, here's one of the contradictory aspects when you try to divest something. Which of these four businesses you think people are most likely to overpay for? The best businesses, your best businesses are often your best divestiture candidates. Why? Because you make money by the difference. So if you have a social media business right now with lots of users, and that's where your future lies, and you want to divest something, that is the business you might want to divest because people are more likely to overpay. This is not about good and bad businesses. It's about what you can get in a divestiture. So next time you hear about a restructuring, you'll hear about a CEO come in and start to sell. And notice how often they sell. And if you sell bad business, you say, I will sell my bad businesses at any price. That's what many CEOs will say. I want to get rid of this business at any price. It's a horrible addendum to a decision process. Because when you do that, guess what you're doing? You're giving away businesses for less than they're worth. Remember when we talked about acquisitions, one of the glimmers of hope you had was to buy private companies and what else? Divisions of public companies, right? What does that mean? Basically, CEOs are essentially giving away stuff and you're getting them at a bargain because they're so intent. They're reading too many Harvard Business School books because they say bad business, you got to get rid of it. Hey, valuation, you can have a great business that's a great divestiture candidate and an awful business that might end up being a business you want to hold on to. Yeah.
Could you theoretically say that if you divest D, though, then analysts will assign higher multiple to you?
You might. There's a pricing effect. That's again the question you got to ask is maybe analysts will all get excited. Look, our growth went up, or because all your fundamentals will look better right after, right? Maybe they'll over-adjust, right? So maybe again a pricing effect can be very different, but from a value perspective, it's very simple. It's like taking a capital budgeting project. So net present value would be negative if your divestiture value is less than your continuing value. Now let's take a follow-up example. Let's suppose you brought in as a CEO of a company. It's got 200 million debt, 800 million equity. So its debt ratio is 20%. Let's say its optimal is 20%. And you want to stay in this financing decision. And you say, the CFO says, look, I'm already at my optimal. There's nothing I can do to lower my cost of capital. I'm already at the optimum mix. Is that true? Is there anything a company can do, even though it's at its optimal, that could actually lower its cost of capital? What goes into cost of capital? Cost of equity for my 80% equity, cost of debt for my 20% debt. What drives the cost of debt? Your default risk. And your default risk is partly driven by how much you borrow. You know what else it's driven by? What type of debt you have. You're saying, why would that matter? If you have a lot of long-term assets and you're funding them with short-term debt, you have a lot of euro assets and you're funding them with dollar debt, what have you just done? You've mismatched your debt to your assets, right? What does that mean? If you mismatch your debt to your assets, you increase your risk of default. So if you're a Turkish company that borrows money in euros to take lira projects, even though you might be at your optimal debt ratio, your cost of capital is going to be higher than it should be because embedded in your cost of debt is an additional default risk. And how do you make it go away? You get the debt matched up. Basically, you do swaps, you do derivatives, you try to match up the debt. And one of the things we're going to talk about is when we think about cost of capital, we always go to the debt ratio. Is that the right debt ratio? But there are other things you might be able to do to bring your cost of capital down. And let's leave one final question. Let's suppose You're looking at a company. Let's make it Google. $60 billion in cash. It decides to buy back $45 billion worth of stock. I have a very simple question. As an investor in Google, will this buyback make you better off, as well off, or worse off? And I'm going to tell you the answer is going to vary depending on companies. So will it make you better off, as well off, or worse off?
Better off.
Okay, better off in what sense?
Because typically tech companies are underlevered.
Okay, that's a good point. Maybe if they're underlevered, it can push up the debt ratio. So one way in which you can become better off is, but first you need some debt, because just reducing equity is not going to bring it down. So if they have some debt, maybe it'll push their debt ratio up. So so one way in which you can be better off is the debt ratio.
I guess it depends on whether or not your opportunities with that money are better or worse than what Google could do.
Well, what Google's doing with the cash is putting it in T-bills. What are your opportunities?
Probably better than that. So
Is it? But you think better in terms of higher return. I mean, anybody can make a higher return then, but what's the definition of better?
well, you could also invest in that, but you could also allocate it into anything that meets your
But does it hurt you to leave the 60 billion in Google though? I mean, I have shares in Apple. I think of my shares in Apple as being 75% Apple and 25% in cash. You know why? Because every $10,000 I invest in Apple, I get about $7,500 invested in their smartphone, their computer business, and implicitly I have $250, $25,000 or $2,500 invested in cash. When you invest in a company with a lot of cash, implicitly you already have a cash. If you don't like to have a cash balance, you can borrow money against the cash. Essentially, that's what you do with margin. So there are so many ways, if you have other opportunities, you can still have them, that the cash by itself doesn't hurt you. But doesn't the value of equity at Google drop by roughly the amount of the buyback? It should, right? Cash leaves the company. Isn't that bad for you? Your stock will be worth less right after the buyback in collective equity. But what do I do to make up for it? What's in your pocket? 45 billion in cash. The neutral case for buybacks is if all it means is cash leaves the company, your equity is worth less, you have cash in your pocket. So a buyback can have a neutral effect. It can have a positive effect if you're underlevered, or what's the other scenario where it can have a positive effect? Do you remember? Go ahead. Remember that when we talked about the loose ends, we talked about, do you trust these guys with your cash? And we had this graph where there were companies you didn't trust with your cash and there was a discount on the cash. Google's not one of those companies, but if this had been a different name on top, a company you don't trust, there's a history of ruining your cash, that 45 billion right now in the company's hands might have been valued at only 35 or 36 billion because you don't trust them. The minute they pay it out, it becomes 45 billion in your pocket. So a buyback can be good news, it can be neutral news, can it be bad news?
Yeah, I believe that, well, just an example, like Waymo just partnered with Lyft to create autonomous driving, so if Google doesn't have the cash balance to fund those investments, I'm getting a bit worried about that.
Okay, so to the degree that you do a buyback, you're sending signals about your growth opportunities. Maybe Google's not as invested in this autonomous car business as you thought. To the bad story is a buyback also tells the world our projects are not as good as they did. And a buyback can also be bad news if you're a small company with capital restrictions, because then you make this even worse, right? You're a small company, great investment, you give the cash back now. What happens if great investments come along? We talked about the option. Financial flexibility is an option. So what's the bottom line? Buybacks can be good news. And the reason I say this is I talk to analysts and they're convinced that if you do a buyback, your stock price should go up. I don't even know. I know exactly what logic drives it. You know what the logic is, right? When you do a buyback, what is the logic that leads them to give you a higher price? The share count goes down, share price goes, earnings per share goes up, earnings per share goes up. If I keep the PE ratio fixed, I get a higher price. Yes, this is great math. It was right until the last step, right? It is true. Buying back shares will reduce your share count. It is true that buying back shares will increase your earnings per share. But it is not true that your PE ratio will stay constant. Why? Because think of what drives PE ratio. You've just made your company a riskier company. You've taken cash out of the company. So there are logical flaws in that, but it's amazing how deeply said it's not just among analysts. I've seen CFOs justify buybacks using this argument. If I do a buyback, my stock price will go up. Right? So let's turn to that slide we were in our packet and start going through this process. So let's talk about value enhancement. I've talked about price enhancement versus value enhancement, and I'm going to show you. Yeah, go ahead.
Yeah, I was gonna ask, what about buying back debt or
You just pay back debt, yeah.
or paying it back?
Can paying back debt be good news, bad news, or neutral? Absolutely. You can make all three cases. When is paying back debt good news? Tesla pays back debt. I will be delirious with joy as a Tesla investor, because for Tesla, this is like, something around your neck. It's put in. So Tesla pays back debt. I'm happy. Why? Because they're over levered. They shouldn't have the debt. With debt, it actually gets much simpler. If you're over levered, paying back debt is good news. If you're under levered, paying back debt is bad news. You're moving away from your optimal. If you're correctly levered, then in a sense you're getting away from your optimal. You have to do something else with the paying back. Maybe you're also buying back stock and making yourself a smaller company. So there it comes down entirely to, are you correctly levered, under levered, or over levered? And again, unless you know which company it is that's retiring the debt, there's nothing inherently good about paying off debt. And again, if you're a value investor, this is viewed as a good thing. You paid off your debt, you become a safer company, as if being safer is enough, right? You're safer by paying off debt. You've also raised your cost of capital because you've given up that tax benefit. So let's talk about the contrast between value enhancement and price enhancement. I'm going to show you a graph from one of my favorite papers. It's called A Rose by Any Other Name was the title of the paper. It was written in the late 90s. And it looked at companies that changed their names. You think, big deal, lots of companies change their names. These companies changed their name in a very specific way. They added .com to their names. They changed nothing about the company, added .com. Let me ask you, in a DCF, where did the name of your company show up? Did you factor that in? This name looks good, I should add another zero. No? I know Starbucks calls everything Italian because they can charge 20% more. That's always a good. Call something, a latte, a grande, a venti. I call it extra large, but then you couldn't charge the extra 50 cents. But in a DCF, if you think about cash flows, growth, and risk, nowhere in there did we stop and say, what's the name of the company? That name sounds really good. Let me add an extra zero. But these companies changed their names. They didn't change their operations. So this subset of companies, nothing about the company changed. All they did was, you are a manufacturing company, you never planned to be online, but you call yourself something.com. We all agree. No value effect, nothing's changed. This is what happened to the stock price of the companies on the announcement of a name change. We've been talking about the wrong things all class. You change your name, your stock price jumps 150%. You've been wasting our time talking about cash flows and growth and risk. We should have spent the entire 25 sessions on what's a good name for my company. Adding .com increase. And many of these were very small companies, so that 150% increase basically, oh my God, it's a .com company. Today, of course, you have your own version of this, right? It's a social media company. It's basically an artificial intelligence company, a cloud computing company. I'm a restaurant. I'm going to call myself a cloud computing restaurant. You don't even know what that means, right? The food will get delivered on the cloud. Go to the cloud to eat. I don't even know what that means, but I'll guarantee you, your restaurant chain, you call yourself a cloud restaurant chain, your price will probably jump 20%. So you're saying, so why, let's focus on name changes. This looks more lucrative, right? But here's the downside. That was a study in the late 90s, peak of the .com boom. There was another study 5 years later that looked at companies that changed their names. You know what they did? They took .com out of their names. This is after the bust, where having a .com in your name was toxic, right? Nobody would invest in you. So .com out of the names. Guess what happens to the stock price? Rises. What the market gives, the market takes away. And this is a perfect illustration of why it's so dangerous to try to keep the market happy. Because that's what you're doing with pricing, right? You're trying to say, oh, what does the market want? Oh, okay, that's what you want, I'll give it to you. The problem is the market is very fickle. 2 days later it says, I didn't like that, no, take it away. And you got to take it away. You manage a company trying to keep markets happy. You're going to destroy the company. It's like trying to keep a manic depressive happy. It never works. There's going to be moments of, hey, everything's good, then everything's going to blow up on you. So when you think about price enhancement, there are lots of things we can talk about. That increases prices, that does it. But you have to be careful about not taking your company down those paths, because if it doesn't also increase value, you're doing things that actually hurt your company over time. Yes, go ahead.
What about the point that we had earlier about like brand names, how that would be baked into the like the margins that you could charge, for example? Would this be an example?
Would you pay more to eat at a restaurant because they call themselves a cloud restaurant? I don't think so, right? So in a sense, that's the thing. That's the test. If you can get to charge twice, it is true, calling yourself a gastropub did increase prices by 50%. So, it is true that sometimes, but I would rather be called a gastropub than a cloud restaurant because I don't even know what a cloud restaurant means. But if it gives you pricing power, then maybe it can affect your cash flows. So let's talk about how to create value. It's very simple. There are only 4 places you can go to create value. First is you can try to get more cash flows from existing assets, right? That's my first stop. Can I generate more cash flows from existing assets? Second stop, I'm going to look at growth. Can I create more value from growth? And what are the 2 ways I can create more value from growth? If I have lots of good projects, I can reinvest more and grow faster. But if I'm taking too many bad projects, the way I get more value from growth is actually investing less. So it can cut both ways. Value growth doesn't always mean higher growth. It means more sensible growth. Second stop. Third stop, I'm going to look at whether I can extend my growth period for longer. You're saying that's easy on a spreadsheet. Just make 5 into 10 and 10 into 15. On a spreadsheet, that's true. But if you think about running a business and having a long growth period, you're talking about earning excess returns and competitive advantages. So this is about building up barriers to entry, competitive advantages. And final stop, is there something I can do to lower my cost of capital? Everything we do in business, every class you've taken at Stern or wherever else you took classes, if you think about the class, there's some number here. One of these inputs that you were talking about, whether it's marketing and strategy, it's somewhere in there. It's about changing value. Okay? So let's think about each of these stops, and let's think about ways in which you might be able to extract more value from it. So I hire you as a CEO for a mature company. What's your first stop? You stop and say, can I generate more cash flows from existing investments? Let's go through some of the ways you can do it. You start at the top. When I hear talk about cost cutting and more efficient operations, assuming you mean what you say, because most of the time people just say it. If you mean what you say, what I hear is higher margins. Because if you can cut costs and be more efficient, I should generate higher margins in the same revenues. If you have businesses that are losing money that you expect to lose money forever, for God's sakes, shut them down. You're saying, why would they still be around if they've been losing money? No. Why does Chris Davis still play for the Baltimore Orioles? If you're not a baseball fan, you have no idea what I'm talking about. This guy hasn't had a hit in like 65 games. They pay him like $15 million a year. I could go out there and swing the bat and do exactly what he does, strike out every single time. But he's on there. You know why? Because somebody signed him, agreed to pay him $15 million a year, and now they don't want to admit to the fact that this is worse than a mistake. People hate to admit to mistakes. So you're saying, why would change now? You know when this happens, divesting businesses? It's when a new CEO comes in. Why? Because he wants to admit to the old guys, but he has no qualms. That guy was a mistake, that was a mistake, that was a mistake. Because he wants to clear the table to make his own mistakes. So if you're losing money, you want to shut it down. Yes?
What if you view those assets as having option value?
Well, then find a sucker that you can sell them to. Because if they have option value to you, then you better start to think about how I convert that option value. So at some point in time, I'm not going to let you so if this is the second year you're losing money, and you say option value, say, okay, I'll give you. 12th year you're losing money, you say there's option value. I'm getting a little impatient about what exactly the option value is. With Chris Davis, there is no option value. If you've never watched baseball, you have no idea what I'm talking about. Turn on the Orioles game. They're playing the Red Sox tonight. He will strike out 4 times out of 5. That's if he has a good game. Usually he strikes out 5 times out of 5. No? That's his regular game. No? I think he actually got a base hit last week. I think he just closed his eyes and swung before he even got to the box, and he actually hit the ball. So maybe this is a new strategy, but we had a mistake called A-Rod on the Yankees for like 3 years after he stopped playing baseball. $27.5 million a year. Why? Because Brian Cashman signed him. And the very act of cutting that contract would have meant I screwed up. So get rid of businesses that are losing money. What I'm going to say next is going to sound mildly unpatriotic, but take it for what it's worth. I have never believed it should be the objective of any company to maximize taxes paid to the government. You might believe otherwise, but I'm going to fully cover myself before you accuse me of breaking the law. Within the framework of the law, I think it's my job to minimize taxes paid to the government. You wrote the rules. I'm just following the rules. So if you don't like the tax law, change it. Don't complain about my taking advantage of it. So how could you reduce your tax rate? Let's look at the ways. You could pull a Bjorn Borg. Most of you are too young to have seen Bjorn Borg. There's no way you could have seen him play. But you heard of him? 1976. I was lucky enough to get to Wimbledon. I watched Wimbledon. 1976, a 17-year-old Swede called Bjorn Borg came out of nowhere and won Wimbledon. Headline, Borg of Sweden wins Wimbledon. 1977, he comes back, he repeats. Headline, Borg of Monte Carlo wins Wimbledon. My reaction was, what the heck happened here? Did Monte Carlo invade Sweden? Is Monte Carlo even a country? I've always wondered about this, right? There are some parts of, Luxembourg. Is that really a country? Is that something that you just fly over, drive through? Maybe something happens in Northern Europe, you completely miss it. People are so placid most of the time. You know what happened? In the mid-70s, Sweden had one of the highest marginal personal tax rates in the world. I think at the Wimbledon level of prices, the tax rate was like 95%, at which point you're asking, why are you mailing the check to me? Just mail it to the government. So somewhere in 1976, Borg started thinking, do I have to be Swedish? Now, ABBA might need to be Swedish, but I can be Monte Carlo. I don't even know whether that's the right word for somebody who lives in Monte Carlo. The tax rates are lower. He moved to Monte Carlo to save taxes. You think companies can't do that? Remember we talked about Pfizer and Allergan? What was Pfizer trying to do? It was trying to pull a Borg, saying, we're really British. Look, we went to Cambridge and we can talk, the right way. And we pay less in taxes along the way. We're willing to change. But you don't even have to switch locations to do this. If you're a multinational, there's a very effective tactic that you can use to lower taxes. You know what transfer pricing is? Somebody tell me what transfer pricing is. What is transfer pricing? Have you ever worked in it? Have you heard of it? There are a lot of job offers in transfer. Don't take them. Horrifically bad job. You will hate yourself. Your soul will get sucked dry. But you know what transfer pricing is? You're a multinational. Let's say Google. Google has Google Ireland and Google US. And when you're a multinational, things get bought and sold across different divisions. So Google Ireland sells something to Google US. It is an implicit transaction, and somebody has to figure out a price on that transaction. That's where the transfer pricing guys come in. You think, what's this got to do with taxes? Which is the higher tax rate, Ireland or California? Ireland. I threw in California because it's not just the US tax rate, it's US plus like 16 other taxes on top of it. I know because I get taxed every single time. I look in a different direction. So if you're Google, you want to make Google California as poor as possible and Google Ireland as profitable as possible. So as a transfer price, so what are you going to do? When Google Ireland sells something to Google California, you're going to charge some really high prices. Of course, the IRS knows this, so they counter. This transfer pricing, the big business is for the lawyers because, of course, there's always going to be a suit. You end up in front of a court and say, $5,000 for a sheet of paper. It's Irish paper. Now, Irish paper is superior quality. That's why we charge $5,000. And you got to then get up in front. And the end game here is you end up with a tax rate closer to our... This is, I think, the classic problem with all the technology companies. At least with physical companies, you can see you sold the car in Cleveland. You can't tell me that the revenues came from Ireland. It's tough to get from Cleveland to Ireland. But if you sell something on iTunes or you watch something on YouTube, you're not in it's in hyperspace. It's up there. So Google says, I don't know, there's this revenue that came from YouTube. YouTube is in cyberspace. It's really Irish. Nobody works there but it's Irish. It's got a dummy out there. No, it looks exactly like YouTube. Transfer pricing. End game is you end up with a lower tax rate. I'm not a great fan of risk management. I think companies manage risk too much. But one of the benefits you might get is by smoothing income out across time, you might lower your tax rate. So if you can lower the tax rate, how does it show up? You put a lower tax rate in EBIT, higher after-tax operating income, higher cash flows. If you've overinvested in the past, live off the fat for a while. Put differently, if you're at 300% capacity, your capacity is 3 times your demand, you don't have to build new factories every year. There's no law that's been passed that says you have to have a new factory every year. Just stop building. And here's what the fat is. You basically get the depreciation in your old factory, so you get the plus depreciation. You have no minus capex, at least for the near term. So guess what? Your cash flows for the next 3, 4, 5 years. And finally, if you're a company built around working capital, a retail company, managing working capital better can do wonders for your cash flows. When I took my accounting class, it was a different age. I remember the chapter on working capital. I remember that class entirely because I try to forget it every single day. But the chapter on working capital, we were told that you should maintain a current ratio of 2. That healthy, do they still teach that to you? Current ratio should be 2. Do they even talk about current ratios? First, you know what a current ratio is, right? It's current assets divided by current. So you were told that current assets should be at least twice current liabilities. That's what healthy companies do. And that's what companies did. They say, oh, we're current. Until Walmart came along and they said, this is stupid. If we keep current assets twice current liabilities, what does that do to your working capital? It keeps it huge. And for a retail firm, this could be $1.5 billion to $2 billion in cash flows. They said, we don't like that rule. We're going to try to keep our current assets almost equal to our current. In fact, what Walmart brought to the process was called I will need a volunteer to run upstairs and get me some batteries. Don't worry, I won't say anything profound while you're gone. Somebody want to try? It's actually just up the stairs. If you go to the right, there's a tech room, an AV room. Just I tell them that you can take this and while he's gone, I'll tell you everything about the final exam. So no, nothing's happening. So don't rush. Right? So what Walmart said was, why should we? In fact, what Walmart brought to the game was just-in-time inventory. If you ever walk around a Walmart, it's this creepy-looking guy kind of scanning as he goes. You know why he's scanning, right? If you have too much inventory, that's basically it. So Walmart's objective has always been to bring working capital needs close to zero. And for a retail firm, that can add a couple of $1 billion to your cash flows. So your first stop when you look at a firm is there something I can do that essentially increases cash flows from existing assets? Any questions? Let's move to the second stop. Is there something I can do to increase the value of my growth? And I'm going to use that return on capital times reinvestment rate equation because it gives me every conceivable way I can think of increasing growth. So first is if I'm in a business where there are lots of good projects, so I'm going to try to reinvest more. And there are 2 ways I can reinvest more. One is to take more internal projects. And the second is if I can do acquisitions, that increases my reinvestment rate, but it'll add value only if the return on capital is greater than the cost of capital. So if I can find projects that make more than the cost of capital, which I'm not taking right now, reinvesting more will increase the value of growth. So if you think, something else? I hear a mic kind of somewhere in the background, so whatever it is, I have no idea. The other thing to think about, when you think about the breakdown, is to think about return on capital. I'm actually going to break down return on capital. I'll catch you up in the 5 minutes. So when you think about return on capital, we normally, the way we define it, take after-tax operating income divided by invested capital. You can actually write the return on capital. Some of you might already have seen this done as the product of 2 numbers. Your operating margin and your sales to capital ratio. Remember those two numbers that I require as inputs in valuation? You take the product of those two numbers, you end up with a return on capital. You think, so what? So what are the two ways you can end up with a high return on capital? One is you can have a really high margin and accept low turnover, right? Because you're saying, I'm a price leader, I'm going to go for the high margin. The other is accept much lower margins and go for a huge turnover ratio. Again, using the example of Walmart, Walmart's path to fame was low pricing, huge turnover. Of course, you're saying, I'd like to have both. But you have to decide which one are you going to go for, high margins or high turnover ratios. And that's why, so when you think about those two inputs in your DCF valuation, it gives you a new perspective on, hey, what kind of story am I telling about my company? That's why I made this big deal about Tesla. You really mean it when you talk about a $35,000 Tesla 3, because that's a very different story. It's a low margin, high sales turnover than a $65,000 Tesla where you settle for a higher margin. Okay? And that's what's confusing when you throw off my story by saying, okay, $35,000 Tesla 3. And if you're earning less than the cost of capital, of course, the entire calculus shifts. Because then when I want to think about higher value from growth, what do I ask you to do? To stop investing, invest less. So when you think about increasing the value of growth, don't just think about increasing the growth rate. That's kind of meaningless, because if you increase the growth rate and earn the cost of capital, it's doing nothing. If you increase the growth rate and earn less than your cost of capital, actually you're doing worse than nothing, you're destroying value. So value of growth is a little messier than just pushing up the growth rate. So when you look at companies that try to grow, there are lots of different pathways you can take, right? You can come up with new products, you can expand an existing market, you can try to compete for market share in an existing market, you can do acquisitions. So let me list out in order, historically, which of these strategies has the greatest chance. So you're becoming CEO of a company. Everybody around you is talking about, let's grow faster. Let's look at the history of value creation from different ways of growing. And this is from a McKinsey quarterly paper that looked at these strategies using their own, because one of the advantages McKinsey has is pretty much half of the S&P 500 is a McKinsey client. They've built up a database, a proprietary database of what these companies did. And they can use that database and they do a very good job. So if you get a chance, again, read the McKinsey quarterly. Great way to receive pragmatic research done with real data. And here's what they did. They went through the 40 years and they classified different ways of growing from very best to very worst. And they measured very best to very worst by how much value is created for every $1 million invested in this strategy. So the top of the list is, hey, come up with a new product. There's been no better way to create value than come up with a new product. So I asked you for a good example of a company that created value from a new product. Apple would be classic, right? Went from 6 billion to 400 billion. What drove it? iPad, iPhone, the not the iWatch, but some I thing. New product. On average, $1 million invested creates 1.75 to 2 million, but there is a catch to this strategy. It's a very skewed strategy. If you win, you make huge amounts of money, but most people who try to come up with new products lose. So it's a high payoff, high chance of failure strategy, but at the very top. Next best is expanding an existing market. How? Either geographically. Okay? So Coca-Cola in the early 1980s hit a brick wall. And the way they grew was they looked overseas. And they got a new... When I valued Levi Strauss, I think when they think about growth, that's their potential, expanding into Asia, because that's where they're least visible. So expanding an existing market. Or it can be by finding a new use for your product. I'm sure Bayer Aspirin got a new breath of life about 20 years ago when they found that, now they've of course taken it back, that taking that baby aspirin every day reduces your chance of a heart attack. And that actually the demand for aspirin doubled after that result came out, because people are now taking, you take an aspirin every day, now you're not taking it for a headache anymore, you're taking it to prevent a heart attack. So if you can find new uses for your product, all the more power to you. Third best is maintaining or growing market share in a growing market. You think about Samsung and Apple over the last decade. Okay? One of the advantages both companies have had for much of the decade is the smartphone market was growing so fast that you could lose market share and still show growth, because going from 18 to 15% of a market that's growing 20% a year meant growth. That bonus is now gone, because I did see one person with a flip phone today, But that might be the last guy left on the face of the earth with a flip phone. He's a finance professor. I should tell him this is an antique. eh? But the reality is the bulk of the growth is now behind us, because right below it is you start to see. So basically the way to read this, $1 million created creates between 0.1 and 0.5. But then you get to the bottom of the barrel. Competing for share in a mature market. Why is that so bad? Why are the chances so much worse? How do you get a higher market share in a mature market? You cut the price. So you get the higher market share, but what do you have to give up in return? You have much lower margins. You get the higher market share, you get lower margins. The net effect can be negative, even though you have a higher. And at the very bottom of the barrel, and you shouldn't be surprised, is historically the worst way to grow is to do acquisitions. And we talked about this for the last session, about why it happens, the ego drive. Here's how I use this. Companies announce growth plans, right? I just look at what their growth plans are. If your growth plan's a new product, I start with an optimistic view. If your growth plans are we're going to do a lot of acquisitions, that's a signal to me. Get out of the stock now. That might be negative, but given history, that's what you're getting out of this. And in many companies, the best pathway to grow is actually grow less. In fact, I'm going to show you a graph that I update at the start of every year, where I look at the returns on capital and cost of capital of individual companies. I do this for all publicly traded companies, all 43,000 companies, and I break the companies down based on whether the return on capital they earn is less than the cost of capital or greater. So the reds are the companies that earn less than the cost of capital. The greens are the companies that earn. So let's start with the easy one first. What do most companies around the world do? They destroy value like crazy. Look at the numbers, 46 plus 12, that's 58% of companies earn less than the cost of capital. And there's no part of the world that's immune. So I've broken it down by region. There is no part of the world, except that part of the world they do sensible things. Stupidity is global. And ultimately what this graph tells me is not that growth is always bad, but growth is not always good. So if you talk about growth, I have to start from a position of skepticism, because you look across the world, most companies have a tough time delivering their cost of capital. Right? So if you go to my web, I did a blog post on this because this is part of a broader issue. There are lots of bad companies and bad businesses that keep trying to grow. Why do they do it? And I don't know the final answer to that, but it's something that you see happening out there. So that's your second stop. See if you can extract more value from growth. Then comes the third stop, where you say, okay, what can I do to make the good times last? And really the question you're asking is what kind of barriers to entry competitive? I'm not a corporate strategist, and I thank God for that every day. But if you ask me to describe big competitive barriers to entry, here are some. The first is brand name. What's the essence of a brand name again? If I talk about brand name, how do you test to see whether I have a brand name? Uber says we have a brand name. What's a simple test for that? If you have Uber and Lyft prices to the same destination, are you picking the Uber even though it's more expensive? If the answer is consistently yes, then we can talk about brand name. Right now, it's the same guy driving, might be the same guy in the same car for all I know, right? He has both an Uber and a Lyft. What do I care whether it's an Uber car or a Lyft car? So when you talk about brand name, I'm going to put you to the test. Show me that you have pricing power, that you can use this brand name. And the answer is yes, of course it's worth a lot. In fact, Coca-Cola, what did we conclude? 85% of its value came from brand name. Yeah.
How would you compare that, in specific
Yeah.
to Uber, how would you compare that? Maybe it's not brand name, but how would you bring in like the fact that they have more drivers or have more people on there? I guess it wouldn't be a brand name.
Not all competitive. In fact, very few competitive advantages are brand name. Walmart has no brand name. But it has some very significant competitive advantages, right? Which is economies of scale, lower costs, better inventory management. So you can be a company which is a great company without even an iota of brand name power, right? You're talking about a networking benefit, a potential competitive advantage, which is as you get larger, it gets easier to get larger because drivers and customers go where the action is. And that's going to be driven by what your market share is. If you talk about networking benefit, I'm going to check your market share. If it's 3%, don't talk to me about networking benefits. If it's 53%, say, okay, I can get it. Second, if you can get legal protection against competition, which for pharmaceutical companies is patents, or if you're Aramco, it is just be Aramco, right? It's a huge advantage, right? It's a huge advantage because you can make excess returns and nobody tries to hone in. So if you have if you can find ways to, and in fact, if you look at pharmaceutical companies, they have entire legal teams. You know what their job is? Is as you get closer and closer to the end of a patent, they try to find, because there are actually ways you can change the compound on a drug and extend out the patent. And of course, this looks terrible from the outside, right? You think that is so unethical, immoral. But you think about what these companies are built on. They're built on legal barriers to entry, and that's basically where they're going. Switching costs. And to me, in technology, this has become the big, you know what switching costs are? Basically, you want to make the cost of switching into your product as low as possible. And once people switch in, you want to make the cost of switching out as high as possible. Have any of you switched cell services? They make it so easy to switch into them, right? You pass by an AT&T store, you're advertising, come on, in 2 minutes we can switch you to it. And they do, in 2 minutes they switch you. And then they give you this 5-page document in really small print, which basically does what? Binds you, your firstborn, your secondborn, your seventhborn, your grandchildren because, and who can blame them? Because without it, cell service is a commodity business, right? Switching costs, you want to make the cost of switching in as low as possible, switching out as high as possible. I mean, mid-80s when Microsoft Office came out, people don't even remember this time in history. They were competing, the WordPerfect used to be a big company that went after Microsoft Word. And PowerPoint had Aldous Persuasion, slide. Every one of these had and over the next decade, Microsoft wiped them out. They wiped them out because they created the first Office suite. And what they realized is when you switch to an Office suite, it became very difficult for you to switch out because you had all your files in that. And now if you decide to switch, you'd have to find 3 different programs. It was a masterstroke because effectively it meant that once they became the status quo. And it's still true, right? I mean, much as we like to complain about Microsoft, what are all my slides in? They're in PowerPoint because I could do it in Keynote. And then I try to send Keynote to a PC user and they turn to gibberish. And even within the Mac and the PC, look how many troubles Microsoft created for me. It turned all my betas into bicycles, remember that? And my sigmas into other stuff. So this is something that Microsoft has built into their system. And again, you can complain about it, but that's the way you keep people stuck with you. In fact, you can think of Uber and Lyft. This is what they're trying to do, is they're trying to create some way of, because when you talk about making businesses more sticky, and that's a word I use all the time. So what do you mean by sticky? Is once I start to use Uber, if they can find a way to make me come back to Uber and make the cost of switching to Lyft high, then they've got a business model working. And right now they can't, I get emails every day from both Uber and Lyft offering me all kinds of nice goodies. I take the goodies and I keep doing whatever I've always done. So they want 10%. Okay, I'll take the 10% off is not going to make it stickier. It's just going to be 10% off, right? So as you look at businesses, especially young businesses struggling, you're seeing them try to create those switching costs. And finally, if you have a cost advantage, build on it. Hey, we talked about Aramco. What's Aramco's biggest competitive advantage? That you stick your finger in the ground and oil comes out of the ground. $7 a barrel to get in a barrel. And if you look at the competitors, it's $20, $25, $30, $50 a barrel. That is a huge advantage. And what are the 2 ways Aramco can take advantage of this? One is to charge a lower price. Saudis can actually let the oil price drop to 20. And they'll still be okay. And hope everybody else goes away. They've tried this before. The only promise, people don't go away. They continue to produce the oil because it turns out to be very difficult once you made that sunk cost to make people go away. So that didn't work. So the other strategy is to charge the same price as everybody else and make a higher margin. In the case of Aramco, where did the cost advantage come from? They were endowed it, right? The Saudis created Aramco by nationalizing all of the reserves that the other oil companies, so this was not Aramco's management that created the cost advantage. They were just given it. But there are companies that work at creating a cost advantage. Like Walmart has worked at creating a cost advantage, and for 30 years that's been its biggest plus when it went up against other brick and mortar retailers. The only problem is when you're going up against Amazon, that cost advantage no longer seems to kick in. So that's the other thing. Cost advantages are not permanent. Dell at one time almost wiped out Compaq because it had a cost advantage. But then Dell went up against Lenovo, and guess who had the cost advantage there? It was Lenovo. So if you have competitive advantages, build on them, and if you don't, try to get them, because that extends your growth period. Last up, is there something I can do to lower my cost of capital? One is, of course, you can change the mix of debt and equity. That's a classic corporate finance response. The second is you can try to match your debt up better, because by matching up debt, you reduce. But there are two other ways that are a little more subtle. Remember when we talked about betas, we talked about how having a more discretionary product can increase your beta. If you can somehow make your product or service less discretionary to your customers, you've effectively lowered your beta, right? And how do you make your product or service less discretionary? You can play mind games. In fact, if I think about advertising, everything you do in business has something to do with value creation, right? To me, the essence of advertising is to convince you that you can't live without something that you're perfectly fine without. If you don't wear Gap, you will never dance again, or remember the Gap dance, or you don't drink Coke, you'll never be happy again. Most of the time the ads just go by us. But to the degree that it works, you're essentially saying you need this, without it you can't live. Or you change the characteristics of the product to the point that you can't live without it. 15 years ago, if I'd asked how many people in this class have cell phones, the answer would have been maybe 30%. So if I took your cell phone away, could you live without it? 15 years ago. Today, if I threaten, this is the only threat that used to work with my kids as they were growing up, my daughter especially. You could threaten her with 15 years in Siberia, unfazed. I'll take your cell phone away for 24 hours. Do everything you want to do. Right? Let's face it, most of us, without our cell phone, we're completely lost. I saw one guy going through the subway the other day, drops his cell phone, breaks it. It's completely shattered. I don't know what my name is. I don't know where I live. I'm completely, this is like your entire life is there, right? It's gone now. You could make a movie, maybe a Black Mirror episode where your entire life is on your cell phone. You break it. You have no idea who you are anymore. Your contacts list is gone. You have no friends. It's become non-discretionary by design or otherwise. It lowers your beta. And we also talked about having a lot of fixed costs increases your beta. We talked about operating leverage. If you can somehow make your cost structure more flexible, sounds fancy. What are you doing then? You're moving fixed costs in the variable cost column. You've just lowered your beta, right? You're saying, how will I do that? If you think about the basis for outsourcing, what were companies doing? They were taking something that they used to do in the company, and now they let somebody outside do it, and they've made a fixed cost into a variable cost. Again, I'm not saying this is an unmixed blessing, because there might be things you give up, but you can see the effect on cost structure and betas. Cash flows, growth rate, competitive advantages, cost of capital. Everything you see in a restructuring is somewhere in there. Next time you see a plan for restructuring, break it down. Say, which item am I changing? And you can see half the items listed will be neutral. You say, why are you doing that? And it changes nothing. But people throw noise into the process, either because they don't know better or just to get you confused. But your job is to look at how these actions play out on those fundamentals. So I'm going to show you two companies to see how this process plays out. The first is a German software company called SAP. Here's what I want you to do. I'll describe the valuation. I want you to think like a CEO, a new CEO coming to the company and say, what would I change in this company? So when I valued SAP, this was in 2005, here's what I found. They were a company that was making margins above the industry average. They were making a lot of money. They were reinvesting a fairly large percentage of it and making a return on capital close to 20%. So overall, they're making high margins, reinvesting well, and reinvesting a lot. File that away, because when you come in, you're saying, what am I going to change? Those numbers are going to provide the baseline. The way they're funded is primarily with equity, 99% equity. Why? Because they've hated to borrow money. They're a very conservative German company. They don't like to borrow money. 99% equity, 1% debt. The value that I got is 106 euros per share. You come into the company and you look at what you can change. Where's your biggest potential for change as you look at those things I described to you? What the only thing that looks like an obvious fix is, because the margins are, if I told you SAP was earning lower margins than the peer group, had a return on capital less than the cost of capital, then you could talk about all the things you can change above, but here the most obvious thing is I can change my debt ratio. To what? Well, it turns out that you can't just pick a higher debt ratio. I hope it works out. So in this table, I've looked at what the cost of capital will be for SAP at debt ratios from 0 to 90%. Their optimal mix, where the cost of capital is minimized, is about 30% debt. So that's one. The second is, and this is kind of a hidden problem, is in 2005 at least, SAP got almost 97% of the revenues in Western Europe and the US. They're very, very developed market centric. And as you well know, even by the time you got to 2005, the growth was going to be in Asia and Latin America. They had a very low presence there. So they're reinvesting a lot and reinvesting well, but they're not reinvesting in big chunks of the world. So you walk in, I make two fixes. One is I made them reinvest a little bit more. I'm not going to go crazy, 58 to 70%, with much of that reinvestment directed into Asia. And I had to be realistic. When I did that, I also had to adjust my risk premium. So basically, I'm pulling a full picture. But I also changed the mix of debt and equity to 70% equity, 30% debt. With those two changes put in, and they're relatively small changes, the value that I get per share is 126 euros. This 20% control premium would have worked for us pretty well here, right? But purely by accident, 106 euros status quo, 126 euros. There's not much I can do in SAP because it's already a fairly well-managed, well-run company. Let's take a contrast. Remember Blockbuster? There used to be all these Blockbuster stores that people used to walk into and pick these boxes with video. I'm sure when you were a little kid, your parent took you in there because I haven't been near a Blockbuster. Somebody actually sent me a picture of, I think, the last Blockbuster store left in the country. There is one. It's like a museum. Okay? So let's talk about Blockbuster. And this is in 2005, by which point Blockbuster's business had been devastated by two developments. The first was Netflix. Netflix at that time used to actually mail, they still sent videos, but they said, we'll mail it to you, and you could just mail it back. And the other was you had Walmart and all those others with those dollar rentals. So squeezed on both sides. People had stopped coming into Blockbuster stores, but Blockbuster did not seem to notice. They kept opening new stores. Why? Because that's what they'd always done. So they're in complete denial, and here's what the numbers look like. They were not making much money. Their margins were low. They were reinvesting about 26% in opening new stores, and they were earning a return on capital of about 4% on those stores, which is less than the cost of capital. The cost of capital was also pretty reasonable, but they were not earning that 6.17%. So you walk into Blockbuster, what's the first thing you're going to try to do? Stop opening stores. Is that asking for too much? Stop, there's nobody coming. Don't open stores. Which is effectively the same thing as saying take zero net present value investments, right? And if I make that zero net present value investment, which is what you do if you don't open those stores, you essentially get a value of $12.47. If you contrast $5.13, $12.47. That's almost 150% increase from just not destroying yourself. Yeah. Yeah. SAP, yeah. Why don't you find more investments is the question. Why do you stop at 70%? For the same reasons, you're thinking about capital as your only constraint. There's people, there's opportunities. So for instance, Apple earns a 35% return on capital. They have $250 billion in cash, right? Sounds like they should be able to take another 1,000 projects. My guess is that it's very difficult for Apple to find projects. They've run out. I mean, the ideas they have are really good ones. They're making a lot of money. But the opportunities to make that 30, so the fact that you make 35% in your existing project, which for Apple is smartphones, doesn't mean that they can take that into the watch or the services or the Goldman credit card business. So that's the problem with extrapolating from past return on capital is it measures what your existing businesses look like. So Coca-Cola earns a return on capital well above its cost of capital, but its growth opportunities have completely dried up. Why? Because people don't drink caffeinated, sugary drinks as much anymore. So it might look obvious, if you're making that much more, there must be projects out there, but that I tend to give management at least the benefit of the doubt, saying, okay, if you stopped here, there must be for a reason, unless it's a region you're ignoring or something that you can do. Yeah. So you're right, you should look for it. So if you really went to the company, that's the first thing you're going to call for is, are there investments we're turning away because we have some arbitrary cutoff? And if there are, taking more will increase value. So 513 to 1247. Yes?
When you're looking at Blockbuster restructured, why did you, on the other hand, why didn't you just make the reinvestment rate?
Zero. I could have made it zero and invested nothing. I got exactly, because if you make the return capital equal to the cost of capital, the reinvestment rate ceases to matter. So you basically can make it any number from 0 to 50% and nothing will change. Okay? Yeah. So let me use that as my baseline for explaining what I think about the value control. Value control, I value the company twice, right? So basically with each of my companies, I get that difference, that's my value control. But for that to be feasible, I have to be able to change the way the companies run. So I take that change in value and I multiply it by the probability that I can change management. That sounds abstract. But let's say you don't like the way Facebook is run. What's the chance you can change it? Zero. Tell me why. First, it's a $700 billion company, so you can't exactly do a hostile takeover. Second, Mark Zuckerberg controls 57% of the voting shares. This game is tilted. And that's actually something to think about. As you think about Lyft and you think about Levi Strauss, they've done the same thing, so the voting and the non-voting shares. If you happen to be in a country, let's say you don't like the way Alibaba is run, good luck to you. You try to do a hostile takeover of a Chinese company, your phone doesn't understand. Right? So those things all factor into the probability of change happening, and you can see that number is going to be different, not just across companies, but across time. And here's what can drive it. First is corporate governance rules can change over time. There are parts of the world where you could not do a hostile acquisition 20 years ago. Europe, in the mid-90s, you tried to do a hostile acquisition of a European company. Can you imagine doing a hostile acquisition of Fiat in 1995? You know where you'd have to go to borrow money? From an Italian bank. You think a lot of Italian banks will lend you money to buy? There is zero chance, because the Agnellis are probably right there in the back room saying, if you sell to them, I'll break your knees. Right? But you know what broke that stranglehold? Telecom Italia was the first big hostile acquisition. What broke that stranglehold was the opening of a European bond market. Okay? So things change. Activist investors. I've talked about Carl Icahn. You might not like Carl Icahn, and he definitely doesn't think about you, so don't worry about that. Okay? But let's face it, you need the Carl Icahns and the Bill Ackmans of the world. Why? Because they shake things up. Because their presence does what? It increases the probability of change. And finally, it's amazing how a hostile acquisition of a company in a sector will make every other company in the sector much more interested in what their shareholders think and value creation. The threat of an impending execution focuses the mind very well, right? So basically, man says, oh my God, we could be acquired next, let's do something. So the probability of change. So when you look at that probability of change, there are ways of estimating that probability of change. There's something called a probit you can do where you can actually look at past data. But it's a subjective number. And you look at a company that has zero chance my company, very high in this, and that can affect the expected value control. That expected value control shows up in multiple places. You're saying, but if I'm valuing a regular publicly traded company, if you're doing a hostile takeover, that expected value of control becomes what you pay as your premium, or you could pay. When you have voting and non-voting shares, I'm going to argue that the premium you pay for a voting share over a non-voting share is a function of the expected value of control. When you have a private company, you know there's what's something called a minority discount? What's a minority discount? What you're willing to pay for 51% of a private business can be a lot higher than what you pay for 49%. That minority discount reflects the fact that at 49% you don't get to run the company. I'm going to argue that the expected value of control will determine all of those things. Okay? So for instance, let's start with the easiest one. If you try to do a hostile acquisition of Blockbuster, the stock was at $9.50 at the time that I did this valuation. What do we come up with as an optimal value? $12.47, right? As a hostile acquirer, you're willing to pay up to $12.47 to buy the shares. But should you pay the entire $12.47? if you do whatever you just done, you paid a $2.97 premium to the shareholders, and you then do all the hard work. So if you're going to do it now, that becomes your reservation price. But let me close today with a very simple object. What's the price? $9.50, right? Let me take the two values. Let's act like those are the right values, status quo and optimal. There's something very interesting you can do with the price. The price is $9.50, and I have the two values. I can back out from the price the probability that change will come. What I'm saying is when you look at the stock price for a company, you're actually getting a weighted average number of your status quo value and your optimal value. In this case, that probability would have been about 60%. The reason I picked Blockbuster is Carl Icahn had actually targeted it. And before he came along, the stock was trading at about $8. And if I took the $8 and I kept the values constant, the probability of management change before he showed up was about 42%. Now do you see why the very presence, the very fact that an activist investor has shown up in your company can affect your stock price? Because the minute he shows up or she shows up, what happens? The probability of change increases, your value, the stock will go up. That's why we should all be grateful for the Carl Icahns and the Bill Ackmans of the world, is when they show up, you and I benefit as stockholders in the company, because that probability of change translates into a higher stock price for all of us. So I'm going to stop there. When we start on, as I said, make sure you send in those Excel spreadsheets with the summaries, because I will do the last few pages as part of my closing presentation. But I will send you a closing presentation about 20 minutes before class. If I can, I'll try to do it a little earlier in the day. Obviously, I won't have a chance to print it and copy it. Bring in the PDF version on your device or print it off for yourself. Bring it to class.
So like,